finance pretty tough for them, and that is really a structural issue. And actually, I would engage and encourage owners to engage with their banks in a proactive manner, and to see, how are they perceived, how is their credit standing, how is the credit metrics, how is their balance sheet viewed by the banks, because the aim should be to reach a BB kind of rating, and it's very difficult if you are in the dry bulk space these days to have the leverage, just because the asset value went down so much. But at least it's important to quantify the problems, and this you can only do if you have a dialogue with your banks. And we see some smaller ship owners that are able to put in place a corporate structure, to put things together so that they improve their rating. But you have to have this dialogue, which is quite important for new business going forward.
So certainly it's safe to say that there's a relative lack of bank finance in the market. We all hear that, but I think for the benefit of all of us here today, it's worthwhile to touch upon some of the reasons why this is the case. It probably illuminates what potential borrowers need to be thinking about as they make their plans for the future. Claudia, what would you say are some of the key reasons that there's a relative lack of finance in the market?
First of all, I think from the pre-crisis levels, the banks are still suffering. So not only the owners have the losses, it's also the bank who suffers millions of losses. And I think Hamish just said in the panel before that it has to be a good dialogue, that the bank understands the ship owner and the manager, but vice versa, the owner has to understand the bank's perspective also, and the bank is not an independent entity. We have shareholders, we have and we have to justify our business. And if we are facing losses in 2-digit million figures, everybody's asking the banks. So you see so many banks stepping out. Here you have the active international banks who are still there for the managers and owners to help. But you have to listen to us. We are doing restructuring and new business discussions with credit risk departments every day. It's our business and we are the experts. And if we are talking to someone and say good management does not mean for the banks good ship management. This is one item. Good management means that you listen to us and that you follow us. And if we are talking years by years that the ship management, family-driven companies have to implement corporate structures, this is a must these days. And if you don't have that, I can only advise you to do so. There are many auditors around. Contact them. They can establish you a structure. And even if you have background shareholders, there will be solutions for it. Make yourself bankable and it will fly somehow.
I think that's actually a very good point, because from ABN AMRO side, we're still supporting the sort of combined figure type operation, where we're effectively financing SPCs in a non-corporate structure. But that is coming to an end, and there's increased pressure also from the bank's internal policy makers that at some stage we need to move into more corporate structures, into more transparency, to see what the entire group is basically entailing.
Yeah, to continue on what Claudia was saying, I think for us it's I think if you look at the banking landscape now compared to pre-financial crisis, there's a lot more regulation and a lot more and a much higher requirement in terms of how much capital you need to allocate towards each loan that you grant. And that, combined with higher US dollar funding costs, has forced the banks to be more selective, to focus on fewer clients, and to get sufficient returns on the new capital allocated to the industry to justify the business going forward. It's not a matter of loan loan losses for us necessary. It's more a matter of, justifying that you have a sustainable business with sustainable returns to our shareholders. So I think that, has for us limited the number of clients that we deal with, and we deal predominantly with clients that can offer the banks an ability to sell other products, not only that we are lending our balance sheet.
Just one comment at the end. I think the market is used to banks going for volume, competing for deals, stretching the terms because they were measured on top line and nominal figures. I think what is happening today because of regulators is that you move from nominal figures to profitability, and you need to find profitability in order to do business. And that is a combination of much of what has already been said, but it also means that not all corporate models fit in with banks today. And you need a cross-sell, there's a lot of components today that you didn't have earlier. And I can only speak on behalf of DNB. We don't do lending for the sake of lending to the extent we did before. We do lending to achieve more. And we do lending with companies that we trust and that we have dealt with for a while, meaning we have all kinds of corporate structures within the portfolio today. But if you want to add a new name to the portfolio today, then we would look for corporate structure more. We would look for corporate governance, certain size, cross-sell potential, and profitability. And these factors really need to be taken into account. One of the challenges is that many bankers lived before 2008 as well, and they also need to adapt to the new reality.
Thibaud?
And probably one comment, there is now a lot of talks in the market about Basel 3, 4 and 2.0 and whatever numbers they have, but and things have not been decided yet, and it's still open in the air. It's a little bit like Brexit, right? I mean, we know it's going to happen, but we don't know exactly how and all the consequences. But one consequence is clear: is that the capital requirement is going to be tighter for the banks and going forward, and that's a trend with Basel IV or with other regulations. So that is regardless of where the shipping market is at the moment. That is across the board.
So structure, governance, what about collateral? What about the value of the vessels themselves?
Can I just say one thing before I left?
Yeah.
One of the key learning points for me is gearing or leverage. Banks are not supposed to be moving parts of their portfolio into equity territory, where we are for part of the portfolio today. Going forward, we need to lower the gearing level for bank debt. And that means more equity or other sources of financing. Banks are not supposed to be in certain situations where we are today with the business model banks should have. So that's a key learning point for me.
So what about collateral? Is collateral less relevant?
No, it certainly is not. I think the recent period has basically taught us that there's actually quite some difference in terms of quality of tonnage and having the right sizes and the right ages, and that is actually quite important. And so if we were to consider onboarding a new client, then obviously, besides the things that we discussed here earlier, the assets, the underlying assets, should be of good quality.
Would you say it's the same for Nordea?
Yeah, and I think another important aspect that I think is worthwhile to think about is I concur with Kjartan in terms of what kind of leverage the bank should be willing to grant, and I think it's also important to think about the age of the collateral that you lend against, and at what point in time that vessel should be fully repaid, because we see in cycles that we have now on the dry bulk side that vessels at younger and younger age are being scrapped. And scrapping is in fact what everyone talks about will save the market. But if it is possible to scrap if you have a debt-free vessel, but it's not possible, or it's very difficult to scrap if you have a vessel that still carries a lot of leverage. That makes it very difficult both for the bank and for the owner. So I would say yes, the quality of the collaterals is important, but also the age of the collateral is of very high importance.
Claudia?
I do fully agree. I think especially in restructuring and in workout solutions and negotiations, the quality of the asset is really of importance. I mean, today when we are approached by buyers who are looking for tonnage on the market to invest now because they're acting on the dry bulk side and the quite good entrance stadium. The first is always, do you have Japanese? Do you have South Korean? Do you have first-tier Chinese? And if you have a lower quality asset, then the purchase price of that vessel is much lower, and the banks do also their homework and lessons learned. I mean, if you come with a lower quality shipyard and you ask for new building financing, we will fully disagree on the values you may apply to it. So the quality is really king here, and I'm very happy that we are all sharing the same view here.
Yeah, which doesn't necessarily mean that I think quality is extremely important. It's not necessarily meaning that we don't finance vessels that are, say, beyond 5-10 years. I think we can still do that, but it has implications in terms of structure, in terms of pricing, leverage, that kind of stuff. But it's sure financeable. Also, if you after 6-7 years need to refinance part of your fleet, that could still work, but as long as the quality of the ships are okay.
And maybe, I mean, DBB is known in the market as having, a strong asset view on our collateral, and we will carry on doing so, no doubt, through our research team and all the support team. On the other hand, and to answer your question, yes, I mean, asset is obviously important, but it will become important because of what we said, and we see, capital structure being more and more important going forward. So the trend is, again, it's there.
What about the impact of private equity on the capital structure? Is it easier to finance a company that has private equity backing? Anybody want to take that?
It could be either or. I don't want to. We have situations where it works well and situations where it doesn't work that well. But we have ship owners that we are very happy to work with, but we also have had some disappointments during bad times. So it's not like one is bad and one is good, but I think you need to, with some ship owners, you would have a reputation part. There are some intangibles that you may not have as a private equity firm. That could play a part. I think you just, what banks would do, we deal with private equity. It's not like we're running after them, but we do certain transactions where private equity is involved. You need to adapt the structure and the way you do business, and just be conscious about who you have on the other side of the table. But there's nothing that is not being considered at all in that respect, at least from our end.
And let's touch on restructuring. How about the other side of the coin with respect to private equity? If you get into a distressed situation, do you find that private equity makes the situation easier or more difficult? Please.
I would say, I mean, same as what Kjartan mentioned about dealing with them entering into the transaction. I think so far our experiences is that private equity is not any significantly different than dealing with normal ship owners, so to speak. I think they have acted, in a rational way, and so far we've had tough discussions with private equity, but we have had tough discussions with traditional ship owners as well. So I think so far I'm not not in a position to say that private equity have performed any worse than what we expected.
Thibaud?
Probably it's, it really depends on the motivation behind the private equity. I mean, is the motivation, okay, I enter into shipping because it's easy to deploy capital, I'm going to go for a fantastic new building program and ask the banks for the maximum leverage. I think these days are gone, and now there has been an adjustment in terms of expectations with the private equity. Now it's more, okay, let's focus probably on second-hand tonnage, quality tonnage, with, partnering up with people that can build up a franchise and be realistic about the exit, and not necessarily the IPO, but try to trade in and out the vessels at the right point, and that's probably as well more suited for the industry. As a result, it really depends on the motivation behind entering into why private equity enter into shipping.
Just wanted to comment that I think many have learned that it's easier to enter shipping than exiting shipping, and probably when you enter, it's because a very smart guy found an exit. So I think many of the new entrants, regardless of the reasons why they entered shipping, have learned that you get in, but to get out is really tricky, and you need patience, and that's probably why you see the rational behavior, whatever we call it, where you actually just need to stick with your investment and keep it going more than you would have expected maybe a few years ago.
Just one thing to add from my side. I think it's and we've always worked on that basis that once we team up with a client or a potential client that is backed by private equity, is that the ship owner itself has relevant skin in the game. And that could differ from owner to owner. Sometimes it could be a very low percentage, but it has to be relevant for the ship owner that is teaming up with private equity.
Okay. Kevin.
Any questions from the floor at this moment? No? Okay, Greg, another question?
Yeah, I have another question on restructuring, and this also picks up with the theme from the prior panel. When is it best to hear from your borrowers about when to commence restructuring discussions? Is there a difference of views? I'm curious if different banks have different views on this. Claudia?
I mean, we are in constant dialogue with our clients, so we expect from them that they inform us as soon as early, so that we give our advice and what might be possible. If not, if you come to us with a fully fledged restructuring plan, we might have a certain different view on that. So as early as possible, and then together, not against each other. And this is also the trigger for new business. We are never saying that a restructured client is not open for new business, because this was also a topic here for the panel, that if we have a well-restructured loan with an existing client, we will be open for new business with him also. If we face losses because he did something stupid without us, there's no possibility to grant new loans against him.
I suppose there are two components. There's the communication piece, and then there's the restructuring transaction, if there is one piece. And these obviously will happen separately. Presumably communication is important across the life of the loan. When is it appropriate, though, to begin a hard look at relaxing covenants or some other part of a restructuring? Or maybe another question on the back of that, how do you identify when a borrower is ready to be restructured, or dare I say even worth being restructured? Are there things in particular that make restructurings obvious? Yeah, please.
No, I think it's important to approach the bank early, but I think the most important thing is that by the time that you approach the bank, that you have, as an owner, thought proactively about what your contribution is going to be in the restructuring as well. I think some owners think that it's, well, or at at least the banks do not view it as proactive. If you approach the bank and ask for a 2-year period of non-amortization without any contribution in terms of cost cutting and equity raising. So I think as important, or if not more important than approaching earlier, is to have a well thought through plan as to how your own contribution is going to be in that restructuring. Because I think it's naive to think that the banks will do all and that it can be achieved only through debt amortization from the banks.
Just what I wanted to add is that you need to get in early, because what often happens is that if you have, let's say, if you have more than 3-4 banks, it becomes complicated, because banks, the first thing they will do is to assess their relative position, and then they will adjust accordingly. And what you need, and what banks expect, is that when you start this process, you need to get, if it's critical, you need to get what is called a standstill, ideally. It takes time to get the standstill in place. Banks would expect that you pay until the standstill is in place, and not the opposite, where you stop paying to force the banks into a standstill. So in reality, depending on the complexity of your case, you need more time than you think from the moment you start a process like this. But the most, I would say, precious advice I could give is to have a continuous dialogue with your bank, so that there is no negative surprises. And the closer you are, I guess, the more consensus you can get when it comes to the solution.
Claudia, please.
No, I think this is basically what I said, and the dialogue is the most important thing, the contribution, and follow the dialogue. That's it.
Two things to add, I think, from my side. The more proactive you are, the longer runway you have. As Kjartan is saying, you buy yourself time to organize properly. And it's my experience that it's not extremely helpful if an owner tries to cut a deal with individual banks. So if you come to a situation whereby it is difficult to service the outstanding debt, it's more helpful if you organize yourself in such a way that the process is incorporating all the lenders. And obviously the lenders are going to look at the relevant relative position, but still you have a process that covers all the lenders instead of trying to cut deals with individual lenders.
I think we have another comment. I also want to work in very quickly one additional topic, which is ECAs. I think ECAs are affecting the landscape considerably. I'd like to have a couple of words on the views from this panel on ECAs and the impact on the availability of bank lending, if we could combine those two.
Combine them. Well, first, I just wanted to very quickly on restructurings. Do you have the management team to cope with the situation? There was a new position launched in Norway related to the offshore space. I think it was an equity analyst suggesting companies should have a CRO, a Chief Restructuring Officer, because you actually need more capacity in these processes. They are difficult to run. When it comes to ECAs, we cooperate a lot with ECAs, I guess all banks on this panel do. They should incentivize for export, and export in shipping is a lot related to yards and order books and vessels. And I think at least looking at our client portfolio, there are less and less new buildings and to finance. So unless there is a new ordering frenzy, which I definitely hope there will not be, the ECA component will be important for still a while. But as the order book shrinks, which I hope it will, I guess the ECA component will be less important as well, because they are there for a reason. It's just not another bank.
Does the presence of ECAs affect the volume that the bank is able to do? Anybody have perspective on that?
Yeah, I mean, it helps in terms of volume, because obviously you can, your counterparty then is not necessarily you can book the risk differently. So it increased the capacity for a bank to service the client's needs. So that helps definitely.
Claudia.
But don't think that the ECA is there as a magician to help anybody, because the ECAs have developed also in the last couple of years, and they give cover only for those who have corporate structure, employment, good quality assets. It's not there just to incentive the export. They have their own credit regulations as the banks have, and so yes, you may get 80% financing, but if you have a solid structure and outfit, you can get a 55 or 60% mortgage loan, and you can get something like a junior loan or a revolving facility as a secured lending part from your bank also, and you save this ECA premiums and a lot of administration work which is burning on you. So ECA is there, yes, it is helping, but ideally it is there for the good clients.
We're getting the signal. I know we're just about out of time.
One more comment?
Any more comments from any questions from the audience?
Probably one comment looking forward. And just a message. I mean, what we see is that the credit world, the finance world beyond shipping, is changing radically. I mean, just take the leveraged finance space. Nowadays, a lot of commercial banks have been pushed out of this market, and it has been replaced by institutional money, by CLOs. And commercial banks have a lesser role and more focused on the regional deals. And I think that it is probably our role as a shipping community, being the owners, being the banks, the investors, to look at this industry and try to make it fit for the next move. And the next move is probably to attract institutional money. But there is a major gap, is that the business model of shipping, if you look at dry bulk and tankers, most of the fleet is employed spot. So which means that the cash flow requirements that you would normally, that these investors, this kind of investor expect, you probably have too much market risk still in shipping. But it means that to compensate that, you will have to strengthen balance sheet and find the right structure. But the future, I think we should all aim at that in the future. Try to make the industry fit for the next move, for the institutional money.
Great.
Greg and the panel, thank you very much.